Of course, this is a complex topic that blends economics, history, and human psychology. Here's a clear explanation of why certain commodities are considered good to buy during wartime, broken down into key concepts. The core principle: scarcity and demand. War disrupts the normal production and distribution of goods on a massive scale. This creates scarcity, less supply, while simultaneously increasing demand, need or desire for the item. According to the fundamental law of economics, when demand outstrips supply, prices rise. Therefore, commodities that are essential to the war effort or daily survival become valuable. Here's a breakdown of the key reasons, categorized by type of commodity. 1. Essential resources for the war machine, the war-fighting commodities. These are raw materials critical for manufacturing weapons, vehicles, and infrastructure. Energy, oil, natural gas. Modern armies run on fuel. Tanks, planes, ships, and trucks are all gas guzzlers. A war disrupts global oil supplies through sanctions, attacks on infrastructure, or the diversion of resources to the military. This causes energy prices to spike globally. Industrial metals, steel, copper, aluminum, nickel. These are the building blocks of warfare. They are used for everything from bullets and artillery shells to tanks, ships, and aircraft. Demand from the military soars, drawing supply away from civilian uses. Precious metals, gold, silver. These are unique. They are not consumed in war, but they act as a safe haven asset. Why? During times of conflict, currencies can become unstable or lose value due to inflation, governments printing money to fund the war. Gold, however, has intrinsic value and is a universal store of wealth. People and investors buy gold to protect their assets from uncertainty and devaluation. 2. Essentials for basic survival, the life-sustaining commodities. When supply chains break down, the most basic human needs become paramount. Food, wheat, corn, rice. Wars often occur in or disrupt major agricultural regions, for example Ukraine, known as the breadbasket of Europe. Farms are destroyed, fields are mined, farmers become soldiers, and export routes, like Black Sea shipping, are blocked. This leads to massive food shortages and soaring prices, both locally and on the global market. Water. While not a typical commodity to invest in like others, access to clean water becomes critically valuable in besieged cities or conflict zones. Companies involved in water purification and distribution can see increased demand. Medical supplies. The tragic reality of war is casualties. Demand for antibiotics, painkillers, bandages, and other medical equipment skyrockets. Supply chains for these crucial items are often severed, making them extremely scarce and valuable. 3. Financial instruments and market dynamics. It's not just physical goods that see movement. Defense company stocks. Companies that manufacture weapons, military technology, drones, and cybersecurity systems often see a sharp increase in government contracts and revenue during wartime, making their stocks attractive. Currencies. The currency of a country perceived as safe and not involved in the conflict, like the US dollar or Swiss franc historically, often strengthens. Investors flock to these stable currencies, increasing their demand and value relative to others. Bonds. Government bonds from stable nations are also seen as a safe place to park money during global uncertainty. Important caveats and ethical considerations. While the above explains the mechanism, it's crucial to understand the bigger picture. 1. Not a guarantee. Investing in commodities during war is extremely risky and speculative. Prices can be incredibly volatile. You could easily lose money if you buy at the wrong time.